Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 50. 50, Peter. Can you believe that?
I was going to just say it's flown by. This has been an absolute blast doing this with you, Charlie, and I think we've got a couple hundred more in us at least.
Absolutely. Okay, what are we going to be discussing today? A lot going on still in the markets, the economy. Number one question I've been getting, Peter, I'm sure you're getting the same, is about a potential U.S. recession. So we're going to discuss that and talk about how to invest if this is a recession. And then we'll go to signal or noise. Huge international stock surge so far this year. So all of those questions last year in terms of is this a signal, the extreme movement in the other direction, so far the answers to that seems to be yes. But the big question people are asking today, is it too late to get into a diversified international exposure? We'll discuss that and more. Okay, let's start out how to invest during recession. First, still a lot of debate, Peter, about whether we're going to go into a recession. The stock market over the past few weeks certainly not behaving as if this is a recession, ripping higher 18% off of the April lows, a crazy move higher, and actually ended last week, Peter, above that Liberation Day tariff announcement. Shocking, surprising a lot of people. Are you shocked by this move higher? And do you think it's an indication that the market is saying no recession, we're going to get that resolution on tariffs sometime soon?
Well, I'm not shocked because you and I talked about this right around Liberation Day that a very likely outcome was this. I don't think this is over. There's going to be more volatility, more crazy announcements. We really are imposing tariffs. There are going to be real consequences for this. I don't think the market is priced in. But the idea that everything was going to completely fall apart, I mean, you and I talked pretty extensively about how that was an unlikely scenario. And so, I'm happy that we're in this spot. I think there's a lot more to come because while everything that was laid out in the beginning is not happening, we don't have the case where everything was taken off the table. I mean, there are tariffs in place now. There's still positioning as if this is going to be continued and serious. I'm seeing the implications with my clients. So I know there are real world effects here. And the question is, how big of a factor will this be relative to everything else going on in the economy?
Yeah, no way to answer the question. Is the market being too optimistic? And, a few weeks ago, we were saying, yeah, probably too pessimistic, assuming the worst case. But now, unbelievably, seems to be discounting a lot of good news to come.
Yeah, I think now we're more in before very fear based. You get these disconnects, great opportunity. But here, I think this seems more fairly priced. A lot of uncertainty around tariffs, but you still have very low unemployment. You still have strong earnings. The economy outside of the tariff war is relatively stable. Yes, increased likelihood of recession because of the tariff war. But here, I think sitting where we were, basically coming into the year and pre-Liberation Day is probably a reasonable spot to be. And we're going to have some interesting news one way or the other for the market to break significantly from here.
Okay, so let's talk about the GDP report we got last week. A lot of attention being focused there because we got a negative print. That was not a surprise, by the way. We expected that. The Atlanta Fed, who puts out their projections, was projecting that for quite some time. So, not a huge contraction, negative 0.3%, but still a downtick. And the fear is it's going to accelerate. But I think it's important, first of all, Peter, to kind of break down how we got this negative number. So it's not typical in terms of the contraction that you see. It's all really due to one area, and that would be net exports, negative 4.8% contribution.
Yeah, not surprising, obviously, right? And it shows how strong the economy is outside of this, right? If we weren't having this battle, the markets and the economy would be on fire.
Yeah, and the reason for this, just digging into the calculation, is simply exports is imports minus exports. So companies did a huge surge in the month of March and even earlier in January and February, pulling forward their purchases, anticipating potential tariffs and saying, why not buy these goods now at a lower price rather than paying those higher duties? Now, interesting, Peter, very little focus was on the federal government, but that actually contracted a little bit, and that's been a big boost to GDP in recent years. And that's primarily due to the cuts in Doge. So beyond just the tariffs, there is that additional risk. And we don't know how that's going to shake out of potentially lower federal government spending impacting the economy. Do you see that as a potential trend as well here?
I think for sure, given everything that's happening now, I think that continues.
So let's break down here. This is fascinating. The trade deficit hit a record high at the end of March. We just got the data here, negative 1.11 trillion in terms of goods and services. So moving really the opposite direction, Peter, of what the administration really wants to see this being reduced. And the reason for that, as we just stated, a huge surge higher in imports, hitting a record high for the month of March, and exports little bit of a boost, but not nearly as much as imports. You're seeing just a huge surge for the month of March. So, really, the question, Peter, is this just a temporary thing for the month of March? And then we're going to see a huge contraction in April. We don't have the data yet, but if you're starting to see some of the data in terms of the ports, fewer Chinese ships coming in, it wouldn't be a huge shock to say that this is going to quickly start to impact the real economy in the US if this continues for some period of time.
And when I talk to small business owners, there is no question that things are going to look very different 60 days from now, 30 days from now. Listen to the Walmart guidance from their CEO and CFO, and you listen to, like you said, the people at the ports. What is about to happen is very, very real. And it's going to be very interesting to see how much tolerance the American consumer has for it.
Yeah, so presumably it might take some time because they bought all of these goods in advance, but so we won't see shortages on the shelves, I guess. Maybe not in a matter of weeks, and maybe it could take months depending on how much inventory they built up. But going back to the idea that we talked about, that you can decouple entirely from China, given the huge dependence we have on them with so many different goods, decouple immediately, which is if you leave the tariff rates where they are, making it prohibitively expensive for many companies, the idea you can do that without significant harm, I think, is probably a mistake.
Yeah, for sure, there's going to be short-term harm, and I think what the market's really uncertain about, the American consumer, small business owners that I talk to that are clients, is no one believes the conviction that the administration is showing here, and the reason is from the first announcement was shocking, very different than what had been campaigned about, and then there have been at least 7 or 8 substantive changes. So like, hey, we're 100% doing this to except for phones, except for car, except we're going to put this off, except this country, right? And so people are paralyzed. They don't really have conviction this is what's going to happen. And I think once the markets and real people know what is actually going to happen here, are we going to negotiate this out? Are we really going to bring these jobs back to the US? It's going to be some combination. Then the market can unfreeze. And I think the market is where it is because even if we get clarity, if the clarity is too late, it will have been enough to cause some permanent damage.
Yeah, you just come back to Econ 101, the wealth of nations, Adam Smith, and what trade has done for the world over the last few hundred years. I think it's important to point out it's been a pretty good net positive, and to try to tinker with that in this way, in terms of just a huge change, shock to the system, to think that that's not going to impact people's wealth. And we're not just talking about imports here, Peter. We're talking about exports. So the retaliation in terms of other countries, we're exporting obviously a lot of services around the world. There's going to be an impact. So for now, I think the market isn't fully pricing that in, the hit to companies like Microsoft and Google and the huge service economy we have abroad. But let's play this out and say we keep these tariffs with the goal is to US to export more in terms of our goods. Well, what's going to be the consequence, I think, is the big question in terms of our service economy, which is far and away the US is the leader right now around the world.
Right. I mean, somebody has to take the jobs if they come here, and I think that's the big question mark. Is what number one, unemployment is near record lows. And number two, and by the way, structurally going to probably stay there. There might be breaks along the way, but when you have the largest generation in American history retiring and the people replacing them, there's not enough people. This idea that there's then from there going to be a bunch of people that want to take these jobs, it's not really possible. So it's going to be very interesting to see where this really ends up.
Yeah, to your point, that a great point you made a few shows ago in terms of if the goal is to build manufacturing capacity, and I think that's a worthy goal for national security type of things. Certainly, that makes a lot of sense. We were doing that already, by the way, but that
Yeah.
certainly makes a lot of sense. But if the goal is to increase manufacturing in the U.S., well, how far do you go? How much of a deficit do we allow? And will companies actually invest in that, knowing that we could have a change of power in 4 years? Right? They're planning not for 4 years; they're planning for super long term. And the changes that have already happened in terms of the exemptions for certain products, and you look at the latest was in the autos right space in terms of parts because there was a lot of complaints there. Well, that change these changes are not small, and if someone's deciding to invest in property, plant, and equipment today, they're not going to want to change that in a few months because everything has been shifted in terms of the actual policy.
Right. And I think what will, what you and I theorized when all this started was that hey, we're going to continue to bring back things like making chips, which we, like to your point, we were already doing anyway. But the idea that Nike and Lululemon are going to move their plants here, the odds of that are probably close to zero. But we're still hearing, the guidance from the administration is still that that's the plan. And so until it sorts itself out, that the market's going to continue to have this higher probability of a recession, and we're going to continue to see trade come way off what we've expected.
Right. And what the interesting thing is that in March, people were expecting consumers to pull back. We talked about the consumer sentiment just plunging, second lowest reading on record. But we said, well, watch what they actually do. And what they actually did was very similar to companies actually pull forward their purchases, especially for big ticket items like autos and appliances. We saw a huge surge in durable goods orders, actually hit a record high, one of the biggest monthly increases on record. So we don't know, right? The data is going to be a little bit crazy over the next few months in terms of the swings. Are consumers now pulling back, or are they still, because a lot of the tariffs, Peter, there's reports they haven't been collected yet. There's a confusion in terms of the collections. So I don't think we've seen the price increases in terms of the tariff. So you still might see another month of this where consumers are saying, let me get this product now before. So it's kind of interesting that it's having the reverse effect in the short run where people are pulling forward their purchases, and that's leading to higher growth than would otherwise be the case.
Yeah, but going to be short lived, and we're going to see a very very different graph here in 60 days.
Well, certainly if it leads to job losses and a
Yeah.
real recession. So right now, what markets are talking about in terms of the prices and looking at credit markets, they're not pricing in a real recession with higher unemployment. Let's say unemployment getting anywhere near 10%, like it did during the financial crisis. Certainly not pricing that in. Not pricing in a hit to overall S&P 500 earnings. If you look at just the move we've seen in the past few weeks, doesn't seem to be pricing that. But a technical recession where you have, let's say, two consecutive quarters of negative GDP growth, well, that's a possibility. Look at economists; they up their expectations now. They're often wrong, so wouldn't put too much weight on this. They're at 45% in the April Wall Street Journal survey. But if you look at the betting markets, they're a little bit above 50-50 that we get that two consecutive negative quarters at some point this year. And I don't think that would surprise you or I. The big question is it going to be a real recession where we see earnings come down, where we see companies do mass layoffs, where you actually feel the pain in terms of the everyday person in America?
Recessions are interesting because I think people expect that it means something narrow, like something very bad. I think with depression, we know what a depression is, right? It's devastating, and there's no question about it for the vast majority of people. But a recession, there's a whole spectrum of recessions. There's very, very severe recession like 08, 09. I mean, people felt that, right?
Yeah.
Most recessions, we don't even know they happened. We get told by the government, hey, by the way, last year there was a reset. We have the data in, and earnings contracted and the economy contracted and we had a recession. And yes, maybe unemployment went up a little bit and earnings came down a little bit and the stock market maybe didn't do great. So, I mean, let's just start with that. All recessions are not created equal. And a lot of the time, we don't even know we're in them till they're over, that they're so mild. The second thing I would say is there's always a chance of a recession, right? So, like, if everything in the world is absolutely perfect, the odds of a recession are still over 20%, right? This is just a natural part. It's called an economic cycle. It's not like the economic go up and to the right all the time, right?
Hmm.
Economic cycle. You expand, you contract, and there's much more expansion than contraction. The expansions often go longer than the contractions, and the expansions are much greater than many of the contractions, which are minor. So, yeah, the odds of a recession, obviously, they've gone up. If you're going to have a trade war, by definition, prices in America are going to go up. You're probably going to see employment issues. Um, People get paralyzed. They don't deploy capital. Something that would dramatically increase the odds of recession. If the market 100% believed that we were going to stick with the plan as stated today with tariffs, the odds of recession would be 90%, right? This is just almost a guarantee that
Yep.
we would go into one. So I think right now the betting markets are basically saying, look, hopefully this thing is resolved this summer, but and maybe we'll have a recession because it went on a little too long. But like, look, when you have low unemployment and in the situation that we're in now, it's really hard to paint the severe recession picture, which is really the bigger thing to be concerned about.
Okay, so let's play this out. Say that this does turn into a recession, and maybe it'll be technical, maybe it'll be real. What should investors be thinking about? So I put together a list here. Number one, and you kind of alluded to this here, is recessions happen. I mean, we have a nice excuse here, if it, then we could call it, we've called it a self-inflicted recession, perhaps, if it's due to the tariffs. But they happen. You go back to 1928, Peter, and look at the shaded area in this chart here. 15 recessions since then, so about once every 6 years on average. Unfortunately, it's not clockwork. There's a huge variation. Sometimes you can go a whole decade without a recession. We saw that after 2009. We didn't hit another recession until COVID in 2020. But 15 of these since 1928. And despite that, a dollar in the S&P 500 grows to $668 over this period of time. And that's 6.9% return after inflation for the stock market.
I'm glad
So,
you said after inflation because every chart I post on Twitter and LinkedIn, someone goes, "This chart's a fraud because it doesn't have
yeah.
inflation in it." Right? So, yes, I mean the
And then the
market
next
finds
thing
a
they'll
way.
say, Peter, is, well, the inflation, you're using the CPI, government inflation, that's not real.
Right. But to your point, the market finds a way. I mean, that's the bottom line. Recessions are normal, and don't try to navigate around them.
Okay, let's go to number two about timing, because people will try to navigate around them. And what I'm showing you here is just a range of possible ways you could time it. With number one being, let's say you're the world's best economist, and this person doesn't exist, but you're the best timer. You predict every single recession accurately from 1934 to 2024. So you sell out of the stock market at the start of a recession and you buy back in at the end. What your total return would be is 10.4% per year. More realistic, Peter, is that you're not going to get out at the exact top of the start of the recession and get back in at the end of it. More likely, you'll sell before it starts and buy after. So I looked at that 9% per year, or you'll sell 6 months after it starts and buy back in a year after it ends, 8% per year. And the important thing to look at here, Peter, pretty stunning: buy and hold, do nothing, ignore the news about the economy altogether, and your return is actually 11.5% per year. Pretty incredible to see this actual data here showing even the best timer would not have outperformed.
Right. Counterintuitive to how most people become successful. They outsmart the competition. They spend more time educating themselves, investing in themselves, and find an edge. That's not going to be the case when it comes to timing the market. The more energy and time and effort and money you spend trying to time it, the worse your potential outcome.
Yeah, and the reason for this, if people are wondering, well, how could that be? It's because the stock market doesn't move exactly in tandem with the economy. It's a leading indicator of the economy. So the stock market often goes down in advance of economic weakness. And it definitely, Peter, as we know, tends to go up way before the recession ends. So if you're getting in and out just based on the economy and you're trying to align that with investing, it's not going to work.
That's right.
Okay, let's go to number three. The old Buffett quote about waiting for the Robins is October 2008. Do you remember this op ed from Buffett where I think it was titled Buy American, I Am?
I do. I do. He was that was, I think, his last really great moment as an investor was his kind of the confidence he exuded, the deals he cut with places like Goldman Sachs in the middle of the crisis. Really a calming voice. It's kind of hard to measure what it meant for people to have confidence to reinvest and help rebuild the economy. And obviously, he came out looking like a rock star.
Yeah, so he writes this op-ed October, you know, really a ton of pessimism. The S&P was already down about 50% at that point in time. Now, it didn't bottom until March 2009. People often point that out. And he alludes to this. He's not going to get it perfect, but he's essentially saying if you wait for the good news, if you wait for the robins, which is a sign of spring, it's going to be over. It's going to be too late. And so, what I'm showing you here in this table is the NBER. They're the official arbiter of recessions in the US. And if you look at the last few recessions and look at when they announced when the recession was over, Peter, the S&P 500 by that point in time is already up on average 61%. And we could see the last one in 2020. They didn't announce the end of that recession until July 2021. The S&P 500 is already up 94% at that point in time.
Yeah, I mean, like I think this is the disconnect for a lot of people is the market's correlation or lack of correlation to recessions. And to your point, leading indicator, and not always right when it leads, but for the most part, it is.
Yeah, absolutely. Okay, let's go to number four, stay diversified. And we talked about this in our bear market episode, how to invest in bear market, but similar concept in a recession, Peter. So if this is a recession, hopefully it's not one like '07, '09, but if it is, you'll be thankful you have something in your portfolio to mitigate those losses in stocks. And I'm showing you here October 2007 peak to March 2009 low. And the gray area is the whole period that was the U.S. economy was in a recession. You had the S&P 500 total return down 55%, bonds up 7% over this period of time.
Yeah, it is for a long, long time. People wondered why do I own anything besides the S&P 500, and what we saw prior to this year was not really normal. You know, everything in the S&P doing better than everything all of the time for forever, and we're starting to return to more a normal world.
Absolutely. Okay, let's go to number five here. Don't fight the last war is a quote from Jack Bogle. Too many investors, individuals, and institutions alike are constantly making investment decisions based on the lessons of the recent past. And in recessions, Peter, this happens all the time. Whatever the asset class that's doing well, volatility is always among those, but tail risk hedges, anything that is based on fear. Gold is definitely in that list as well. People chase that thing that has done well during this period of weakness for stocks, and it ends up being a disastrous long term decision.
Yeah, recency bias is very, very real. We tend to forget everything that happened 5 years ago or more and focus on what happened in the recent past to try to extrapolate decisions from there. Of course, that it doesn't work.
Okay, so those are five ways to think about investing during a recession. Hopefully, it doesn't become one, but you have some tools now to deal with it. At Creative Planning, we help our clients with this and much more. So reach out to us today at creativeplanning.com/Charlie. Get a free wealth path analysis at Creative Planning. We're in all 50 states, so we likely have a location right near you. Over 350 billion in assets under management and advisement. We're here to help. So reach out today, creativeplanning.com/Charlie. Peter, let's go to signal or noise. Incredible chart right here. This is as of the first 4 months of this year. Safe to say nobody predicted this coming into the year.
Right.
11% return for US stocks, for international stocks, and negative 5% return for US stocks. The 16% spread, biggest on record for a 4 month period. So the question that we're getting now, which is kind of unbelievable, is it too late to get into international stocks?
Yeah. I mean, international stocks lagged the US for 15 years. So this would have to go on for a long, long, long time to get back to the regression of the mean that would be normal. So if definitely not too late. But I wouldn't be surprised if this gap narrows dramatically by the end of the year when if tariffs get resolved. There is no question that international is heavily discounted to the U.S. without the tariff situation. You add the tariff situation in, this gap widens. We resolve the tariff situation, it probably narrows. But this rotation from US to international is something that everybody from BlackRock to Vanguard to Goldman has been predicting for forever, right? And this is the one thing that most investment houses believe is that this rotation is long overdue. The dividend yield is greater overseas. The PE ratio is lower overseas. But there are people that think there's legitimate reasons for that. Like some people say Europe's a museum and that it's overregulated, and there's the heavy cost of socialism. And Greece was a warning sign of what's to come for everywhere. So I don't think we can just look at it and blanket say this is going to be sustained or not sustained. I think both have been relatively fairly priced for a long time, and the smart investor should have eggs across both these baskets.
Yeah, just pulling it back here and taking a longer term view to your point in terms of this is 4 months and it's an extreme 4 month period. There's no doubt about that. But we came into the year more than three standard deviations above the mean in terms of the ratio of US to international. Highly stretched. And now we're just coming back, but still well above what we've seen. If you want to take any type of average, still more than two standard deviations above. So yes, in the next few months, it'll be choppy. Next few years, it'll be choppy. The overall point is we don't know what's going to happen in the future. So you need to protect yourself in case this does continue. You want to have something outside of the US market. And in terms of rolling 5 year returns, Peter, even with this huge period of outperformance during the last 4 months, it's still 14 years running. I checked the data again, just updated it through April of 5 year returns in the US being better than international. You could see this blue area. That's a long time, 14
Yeah.
years. So I don't think
Yeah.
you erase that gap in a period of 4 months.
No, we got a long way to go to get back to level.
Absolutely. So stay diversified. And thanks everyone for watching Signal or Noise. If you're watching this on YouTube, take a moment, hit that subscribe button for all the latest content from us, and we'll see you next time on Signal or Noise.